Okay, so remember as we were talking about, we said that the annual for you to get, because is the question we're asked to use straight line method of depreciating the asset to depreciate this particular investment. Yeah. And the value of that investment at the beginning, before even at the beginning of the year, is 48 million. So, and that proposal is for 5 years. And they say we should use straight line method. So just say 48 million divided by 5 will give you the annual depreciation, which means our annual depreciation is going to be the 9.6 million. So which means every year that asset, the value of this asset is going to be reducing by 9.6 million. So 48 now, this amount, 48 million minus 9.6 million. So which means in the second year it's going to be 38,400. So 38,400, 38,400 will be our annual our value of investment in the second year. Then of course, in the third year, if you also say you're also going to minus 9.6, it's still going to give you 28,800. Again, minus 9.6, again, minus 9.6, it will give you 19,200. Then minus 9.6 is going to give you, of course, 9.6 at the end of the period. So that is that. So now, in this case now, we now want to look at now the that is so at the end of the period, that's what we have as the value of that asset at the end of the 5th year. Yeah. So now, okay, that's the value of the asset. So because remember, we are asked to calculate, say we should calculate we're asked to calculate, prepare the statement, the management statement, of profits that shows investment proposal and also show residual income and return on capital employed. So in that case now, so in this case, okay, the next year, remember in this question, the examiner did not give us what they call the net profit, because remember the value of each investment every year is this. But remember now, in this question, the examiner, there are times the examiner might not give you what they call your net profit, which means you have to look for it. Remember, we said that net profit is revenue minus divisional costs or controllable costs and all that. So, but in this question, if you go back to this question, if you go to additional information number 1, they said that expected increase in revenue following the improvement is 40%, which means as a result of that investment the company made, the expected improvement in revenue is 40 million per annum. But the average contribution to sales ratio is 40%. So they are talking about, okay, that as a result of this investment the company want to make, now the company is intended to make, the revenue the company will generate is going to be 40 million annually. But that's the revenue. Then from that revenue, the company is going to be making a contribution of 40%. Yeah, which means a profit of 40%. That is what they are talking about. A contribution. A contribution simply means contribution is sales minus variable cost and all that. That's contribution. So in that case now, in that case, I have to go and determine, okay, what is a contribution? Contribution. Yeah. They say contribution is 40% of our sales value. And if you go to the question, the sales value is 40 million. So 40% of 40 million will give us 60 million. So which means every year, our contribution will be 16 million every year. So which means every year our contribution will be 40% of our 40 million, the contribution. So 16 million here, 16 million here, 16 million here, 16 million here. Remember, what you are looking for is our net profit. Because remember, whether you are going to determine your return on capital employed or residual income, you need net profit. Remember, the formula for return on capital employed is net profit over capital employed or investment times 100. While residual income is net profit minus the imputed cost. So whether you are going to calculate for return on capital employed or residual income, you need your net profit. But in this question, because in this question, the examiner did not give us our net profit, we are the one going to determine our net profit. Yeah. So, and then I said, as a result of that investment, that particular company is going to be generating 40 million as a revenue. And again, then I say, okay, from that 40 million, the contribution is going to be 40% of that 40 million. So 40% of that revenue is going to be about 60 million every year. So for us to get net profit now, which means we have to go, first we have to go and now a kind of remove other expenses like depreciation. Like in this question, we have depreciation, remember, for us to get net profit, because contribution is not equal to the net profit in this case. So which means we have to go and remove what we call the depreciation. And remember, our depreciation is 9.6. Why? Because 48 million divided by 5 is going to give us 9.6 million. So we have to go and remove every year 9.6 million, 9.6 million, 9.6 million. So which means our net profit, 16 minus 9.6, how much is it going to give us? 16 minus 9.6 will give me 6.4. So which means every year we have 6.4, 6.4, 6.4, 6.4 as our net profit. So which means our net profit every year is 6.4. Yeah. So of course, remember this is a profit. So we have gotten our profit and all that. So of course, imputed cost now, imputed. Remember imputed cost, or you call it interest cost. Yeah, imputed cost or interest cost. That's the name. And imputed cost, remember we said, is the interest rate on the value of the investment. Now, if you go back to this question, it's covered that additional information, but you say the cost of capital, that's another word for imputed cost, that's cost of capital. Cost of capital simply means is the costs you incur for borrowing money, for borrowing capital. Anytime you borrow money for investment, you must incur the cost of capital. So we call it imputed cost. So the cost of capital is, they say, is 16%, yeah. They say, okay, cost of capital is 16%, and Division has a target return on capital employed of 20%. So in this case, we are going to say 16% because you charge it on the value of investment. So 16% of this one will give us the imputed cost or cost of capital for the year 1. 16% of this amount will give us for year 2 and all that. We keep going up to the end of the question. So in this case, which means we have to go and determine, okay, what is the 15%? Is it 16% of that amount? 16%, I mean, 16% of 48 million is going to give us 7680. So 7680 is that 7680. I mean, yeah. So this one again, 16% of 38, 16% of 30, 16% of 38,400 will give us 6144. 6144. 16% of 28,800. 16% of 28,800 will give us 4608. 4608. Then 16% of 19,200. 3072. 3072. Then 16% of 96. 16% times 9,600 will give us 1536. So 1536. So the difference will give us a residual. Can you see residual income? Yeah, will give us a residual income. So in this case, we have to a kind of okay, so that's that. So residual income is going to be 64 minus 7680 will give you 1280. So we have 1280, 1280, 64 minus 6144, 64 minus 6144 will give me 256, 256, 64 minus 46, 64 minus 4608 will give me 1792, 1792, 64 minus 3072. 3328. 3328. Then, of course, 64 minus 1536. 4864. 4864. So that is that. So that's our. So now we want to now calculate ROCE, return on capital employed. Remember, we say return on capital employed is net profit over capital employed investment times 100. So for the first year now, we have determined our residual income now. Now the next is the return on capital employed. So which means I'm going to say this net profit, which is 6,400 divided by 48,000 times 100 is going to give me my it's going to give me my residual income. So that's that. So which means I'm going to say 6,400 divided by 48,000 times 100. So which means 13.3. 13.3% is my what? Is my residual income. Then the second one I'm going to say 64 divided by 38,400. 64 divided by 38,400 will give me times 100. 16.67. 16.67. Then of course the third year is going to give me, the third year is 64, 64 divided by 28,800, times 100 will give me 22.2. 22.22%. Of course, the fourth year is 33,208 divided by 19,200 times 100 will give me 17.3. 17.3%. Then of course 9696 divided by, oh sorry, no, not 96, 4864 divided by 96 times 100. It's going to be 50.67. So this is the return on capital employed. This is the return on capital employed. So that is that. So that is that. Okay, so let me check again. Let me check 22.2. The fourth one is supposed to be 64 divided by 19.2. Yeah, that's sorry, it's 33.33. Supposed to be 33.33 here, 0.33%. Then this one is 64. It's supposed to be 64 divided by 96. 66.67. Sorry, 66.67%. So this is how to determine. That's A. This is A part of the question. This is A part of the question. So let's go to the B part of the question. Yeah. The B said we should comment on the use of figure from the statement in A above as a decision-making and management performance. Remember, that's what A or B says. We should kind of, so which means in this case now, we are actually want to know, okay, what's going to be our decision on the A part of the question. They want us to determine which of the so which means if you look at in this here, remember if you look at now, they want us to make a decision. Okay, let me see the decision here comment on the use of figures from the statement of profit as a major performance and all that. So they want us now. Now I can say the management is motivated to focus only on the outcomes of the first year, for any new project because of the criteria used for performance measurement and investment decision. Using straight line method, residual income is negative. If you check, residual income, is negative in the first year. I don't know whether you have observed. In the first year, residual income is negative. If you please supposed to be that residual income in the first year is supposed to be negative. Yeah, it's supposed to be negative. Yeah. The residual income is negative and the return on capital employed is 13.3. It's less than the targeted return of 20%. Therefore, if the focus only on the performance measure for the first year, the project will be rejected, even though the residual income is steadily throughout the 5 years. Now, what is talking about here is this, because they want us to comment on what we computed in A. Now, if you check in A very well, in that A, in the first year, the residual income of that particular company, the proposal they want to do actually is negative. Yeah, and also the return on capital employed is actually very low. Now, and it's low because we are told that before a company, now if you look at the big part of the question, they say the return on capital employed that is given as a benchmark. That's what we call benchmark. Benchmark here simply means because in the big part of the order, Roman number 2, they gave what they call a targeted return on capital, which means any project you want to execute, the return on capital employed should not be less than 20%. That is like a benchmark given in the question. So which means if I have a proposal, if I have an investment to make, and I need to know what is the return on capital employed on that particular investment. Now, the benchmark for the company is that any proposal, any investment you want to make, the return on capital employed should not be less than the 20%. And if you look at the question very well, in the first year, of course, in the first year, the return on capital employed, is even, less than that benchmark. Second year is even less than that. The third year, is a bit, is going higher. The fourth year is also going higher, also the sixth year and all that. So, which means if we are going to focus on the performance measure for the first year, which means this project should actually be rejected. Yeah, if you want to measure the performance of the company, this particular investment for the first year only, we are going to reject this project. But of course, first and second year. But from the third year, which means the company, that particular proposal or investment will start making profit and all that. Because if you look at the first and second year, that particular investment has a low return on capital employed and also even a negative residual income. It was from second, third, and the fifth year that company start making a steady amount of profit and all that. So that is what the B part of the question is talking about. So you explain just an explanation and just make a comment. Then the C now said we should calculate residual income and return on capital employed for year 1 using the alternative proposal. So now they are asking us to calculate again residual income and the return on capital only for year 1, but using what you call an alternative proposal. Okay, let's check what is the alternative proposal. Go to the additional information number 4. You see that the management staff turnover at package division is high. The division investment decision and management performance measurement are currently based on the figure for the first year of the proposal. In addition to the above information, there's an alternative proposal that suggests a forecast of the increase in revenue per annum from the premises improvement as follows. Increase in revenue, you have 56, 40 third year, 24 and 16. So these are the increase in the revenue as a result of that proposal. So now we now want to look at they now ask us to calculate the return on capital employed and also residual income only for the first year. Only for the first. So now this is the C part of the question. So we want to compute now the computation of residual income and return on capital employed. Return on capital employed. So if you check very well now, first, remember I told you, if you are asked to compute for the return on capital employed or residual income, if net profit is not given to you, you have to go and look for it. Why? Because you need net profit, whether for return on capital employed or for the residual income. Remember I said the return on capital employed, the formula is the net profit over capital employed times 100. While that residual income is net profit minus the interest cost or imputed cost. So you still need the net profit. But in this question, our net profit is not given to us. Remember, only year one. Year one. That's what we are computing for. So remember, as I say, okay. Now, the investment first. Investment. The investment, remember, going back to the first year in the question, the investment for the first year is not for 8 million. Yeah,